Commercial real estate is the biggest bubble since the 2008 global financial crisis, maybe bigger, and it looks like as we speak, powerful people within the world of finance are setting up teachers of all people to be left holding the bag when the bubble bursts. What's up, guys? I'm Nobody Special, and yesterday on my morning live stream, I theorized that pension funds might be used to bail out banks and asset managers who right now are holding trillions of dollars worth of toxic debt tied to commercial real estate. Office buildings, retail stores, and multifamily housing are all very costly to maintain. There's vacancies everywhere. And after raising interest rates to fight inflation, these buildings are no longer worth anywhere near the massive mortgages that were taken out to buy them. This leaves some of the wealthiest and most powerful people in the world with a big problem. They need to find somebody to buy this stuff. They need them to pay way more than it's worth, and they're running out of time to get it done. So who in their right mind would be willing to buy something that nobody really needs or wants and pay way more than fair market value for it? Well, if you're a teacher, then sadly, the answer might be you. You're going to buy it. Or more specifically, your pension fund is going to buy it. And that means ultra-wealthy bankers and real estate tycoons may be about to pig out at the expense of your retirement nest egg. And with that, we are going to shrink my big melon of a head, and let's get into this article. Here we are, dated just yesterday morning. Blackstone raises more than $30 billion for a giant real estate fund. Asset manager closes on the Blackstone Real Estate Partners X. This is a brand new fund that Blackstone, one of the biggest asset managers in the world, is setting up, and its focus is going to be on commercial real estate. Blackstone has closed in on its largest global property drawdown fund, targeting opportunistic deals across sectors such as rental housing, hospitality, and data centers. In other words, commercial real estate. The company secured $30.4 billion of total capital commitments for the fund called the Blackstone Real Estate Partners X, according to a statement on Tuesday. And it was this sentence here that really stuck out at me. The company secured $30.4 billion of total commitments for the fund. Well, the article doesn't say where that money came from. Who committed $30.4 billion to this fund? We're going to see later in the video, nobody wants to touch this stuff, not with their worst enemy's money, not with a 10-foot pole. I wouldn't go anywhere near commercial real estate right now. This is toxic sludge. Well, after searching far and wide, I finally found an article that wasn't hiding behind a paywall that was willing to talk about who was fronting this $30 billion in cash. And I wound up on this website called IPE Real Assets. And here they're talking about the same thing. Dated yesterday, Blackstone's global real estate fund closes at $30 billion. And here it is, folks, in print. As previously reported, the Teachers Retirement System of Louisiana, the Arkansas Teachers Retirement System, the Oklahoma Teachers Retirement System, Tennessee Consolidated Retirement System, the Minnesota State Board of Investment, and the Teachers Retirement System of the state of New York, and the New York State Common Retirement Fund were among the investors to commit capital to Blackstone Real Estate Partners X, or BREP X. It's all pension money that's going into this fund, and it's a lot of pension money. It's tens of billions of dollars, and it's from teachers in states all over the country. We're not talking about a red state thing here. We're not talking about a blue state here, folks. We're talking about Arkansas, Oklahoma, Tennessee, but also Illinois, New York. This is teachers all over the country are having their retirement money put into this brand new fund that's been created by Blackstone. Now, I should note that it's mostly teachers' pensions included here, but the New York State Common Retirement Fund is not just a teacher's pension. That's for all state employees. And the same thing goes for the Tennessee Fund. All right, so we've established now that it's teachers' pension money that's being funneled into this fund. But that doesn't automatically mean teachers are being set up to fail here, right? This doesn't automatically make every teacher in America a bag holder. Maybe commercial real estate is really just a great investment right now. Maybe Blackstone sees the writing on the wall and they're saying, all right, when there's blood in the streets, buy real estate, right? Maybe they're getting out in front of a market trend and the teachers are actually going to do really well. Well, let's see what the rest of the market sees. And this might be a good time to bring up Blackstone's other real estate investment fund that's been making the news lately. And if you've been following this channel, you know all about this story. The Blackstone REIT, otherwise known as the B REIT, limits investor redemptions again in March. You see, Blackstone already has a fund like this that specializes in real estate. And 5 months ago, Blackstone told their investors, you're not allowed to withdraw your money from this fund. People were starting to panic about the real estate market and they were withdrawing their money. That was forcing Blackstone to have to sell some of these real estate assets in order to raise the money to meet withdrawals. Well, the act of selling assets lowers the value of those assets, and Blackstone was worried that withdrawals from this fund were going to trigger a collapse in the commercial real estate market. So, what does a typical tyrannical globalist elitist do when people are stampeding for the exits? Well, the only logical thing to do: slam the doors shut and lock everybody inside, not allow people to withdraw their own money. Here we are in Reuters, dated April 3rd. Blackstone said on Monday it had again blocked withdrawals from its $70 billion real estate income trust in March as the private equity firm faced a flurry of redemption requests. Blackstone has been exercising its right to block investor withdrawals from BREIT since November after requests exceeded a preset 5% of net asset value of the fund. So maybe I'm wrong here, and maybe this new fund that Blackstone is creating is really a good investment, and all the teachers from around the country whose money is going to be put into this fund are going to do really well. But if that's true, why is the same company, Blackstone, slamming the doors shut and locking their own investors inside their other real estate fund that invests in the same garbage asset class? If this is such a great investment, then why are they treating it like the hedge fund California? Check out anytime you like, but you can never leave. And folks, this commercial real estate problem is not limited to just Blackstone and just this story about teachers' pension fund. The stink of commercial real estate debt was all over this recent spate of bank failures that started a few weeks ago in mid-March with the failure of Silicon Valley and eventually Signature Bank. Commercial real estate has played a huge role in all the losses at these banks, and since the FDIC stepped in and bailed out these banks, they've been slowly breaking up the bank's assets into pieces and selling them off. But the one thing nobody has been willing to buy from any of these failed banks has been their commercial real estate investments. Nobody is willing to touch this stuff with a 10-foot pole. Check this one out in Bloomberg, dated a few days ago. After Signature Bank deal, the FDIC is left with $11 billion of toxic waste loans. NYCB, or New York Community Bank, leaves behind loans on rent-regulated apartment buildings. Now, when New York Community Bank stepped in and bought the leftovers from the failure of Signature Bank a few weeks ago, they left out specifically all of the commercial real estate debt in New York City. NYCB was very adamant that they did not touch one penny of debt tied to commercial real estate loans. Now, keep in mind, NYCB got a sweet deal. There were all kinds of goodies like lines of credit and free insurance that the FDIC gave NYCB in order to take on the assets from Signature Bank. But even with all of those pot sweeteners included, NYCB was not willing to touch one iota of commercial real estate debt. Dated March 21st, Signature Bank's partial takeover by a competitor is notable for what it doesn't include: $11 billion of loans against a class of New York City apartments whose values have tumbled in recent years. In a deal with the Federal Deposit Insurance Corp, New York Community Bank Corp is buying more than $34 billion of Signature's deposits, as well as $13 billion in loans and 40 bank branches. Left behind is the commercial real estate debt portfolio, weighted heavily towards multifamily buildings bound by a law that restricts landlords' ability to raise rent. It's toxic waste, said Christopher Whalen, chairman of Whalen Global Advisors. From an investor point of view, these are dead assets. So once again, if commercial real estate is such a great investment for the teachers in all of these states, then how come Blackstone has locked up their other hedge fund and not allowed anybody to withdraw money? How come NYCB was unwilling to touch any of this stuff when they bought out Signature Bank's assets? But still, folks, it gets even worse. Here's another story in Bloomberg dated April 5th. BlackRock, now that's a different company, Blackstone and BlackRock, two different outfits here. BlackRock to sell $114 billion of failed banks' securities. The FDIC was stuck with Silicon Valley Bank and Signature Securities. The agency says it will avoid any adverse impact on the market. And what's in these securities from Silicon Valley and Signature Banks? Well, it's funny you should ask that. BlackRock was hired by U.S. regulators to help sell $114 billion in securities it amassed from failed lenders Signature Bank and Silicon Valley Bank. The firm will conduct sales of $27 billion in securities from Signature Bank and $87 billion from SVB. The holdings are mostly agency mortgage-backed securities, in other words, bonds that are made up of loans against real estate, collateralized mortgage obligations, again, more real estate debt, and commercial MBS, commercial mortgage-backed securities, that remained after the government sold the rest of the firms in March. So what happened here is the taxpayers bailed out these banks. They bought up all the assets and made the depositors whole. All the people who had money in the bank were bailed out. That leaves the government holding this steaming pile of hot garbage. The government sold whatever could be easily and quickly sold without causing some type of market mayhem, and now the taxpayers are left holding this fancy word salad for real estate debt, both residential and commercial. And it's going to be so hard to sell this stuff that they had to hire BlackRock to come in, and BlackRock is assuring everybody that they're going to sell this stuff nice and slow, not dump it all on the open market all at once and crash the price, which could lead to more bank runs. You can't easily sell this stuff because nobody wants to buy it. There's no need for it. We have too many stores in America because everybody shops online. We have too many offices in America because everybody is working from home. So who do you sell this to? Well, typically what they do with stuff like this is they package all of these loans up into a bond or a security or a mortgage-backed security. Then they break it all up into pieces and they sell it just like stocks. That's what they typically do. That is assuming anybody wants to buy it. But ever since the Federal Reserve has been raising interest rates to fight inflation, nobody wants to buy securitized debt backed by real estate. Here's another one in Bloomberg from about a month ago. Commercial property market freezes, sending bond volume plummeting. Offices, retailers default, little incentives for mergers and acquisition deals. Everything is frozen, says Conning & Co.'s Paul Norris. Sales of commercial mortgage bonds have fallen off a cliff, plummeting about 85% year over year as rising interest rates cut into lending volume and defaults spook investors. Now, keep in mind, this article was written in February, so this problem has only gotten worse ever since. Only about $4.27 billion of bonds had been issued so far this year, down from $29.38 billion at the same point last year, according to data compiled by Bloomberg. Investors blame the Federal Reserve's aggressive interest rate campaign, which has made it more expensive for borrowers to refinance. Higher rates have also cut into sales of properties by effectively lifting prices for buyers. Adding pressure is a recent string of defaults in office and retail property sectors, making bond buyers even more wary. So these companies have been unable to package up all these loans into bonds and sell them onto the open market this year because there's no market for these bonds anymore. The issuance of these bonds is down 85% year over year. This market is just frozen in place. So if there's nobody to buy this stuff, and the FDIC is sitting on $114 billion worth of this stuff left over from failed banks, how do they sell it? Especially when Blackstone has already had to slam the doors shut on their existing real estate fund because too many people wanted to withdraw their money. So you can see now how some really powerful, wealthy people have a big problem. They need to unload this stuff. Now, there's a whole other problem here that hasn't been mentioned, and that's the fact that the clock is ticking. The thing about commercial real estate debt is it's not like residential real estate debt. With a residential real estate debt, you get a 30-year mortgage, and you make small payments over 30 years. That loan isn't due for a long time. Commercial real estate debt doesn't work that way. Commercial real estate is much shorter duration, anywhere from 1 to 5, maybe 10 years before these loans need to be paid back. That means debt that was taken out a year ago or 3 years ago or 5 years ago needs to be paid back over the next couple of years. Well, a few years ago, interest rates were at almost zero. You could essentially get your hands on free money. The pandemic forced the Fed to lower interest rates. The Fed was buying up all kinds of bonds and everything. It was just free money for everybody. Stimmies were flying. And so these loans were very cheap. People were able to pay more than these buildings were worth because the debt was so cheap. And so they were able to keep buildings alive that should have gone out of business a long time ago. These buildings don't cash flow. The stores are vacant because people are shopping online now. The offices are vacant because people are working from home, so they don't need as much office space. And residential real estate has its own set of problems. Because of inflation, the cost of living for most people who live in multifamily real estate has gone so high that a lot of these people can no longer afford high rents on these buildings. Well, if people don't pay their rent, then landlords don't pay their mortgages. And if landlords don't pay their mortgages, then commercial mortgage bonds default. And as you can see here from this article in the New York Post dated April 10th, the clock is ticking on this debt. They can't just sit around and wait for things to improve. They've got to unload this stuff fast. Default risk grows on $1.5 trillion with a T in commercial real estate debt. The risk of default in the commercial real estate market is growing as office and retail property valuations could drop by as much as 40%, while nearly $1.5 trillion in debt is due for repayment by the end of 2025, according to analysts at investment banking giant Morgan Stanley. $1.5 trillion of this stuff has to be paid back before the end of 2025. They have got 3 years to unload $1.5 trillion of this crap onto unsuspecting investors before they have to pay back the loans. Now, normally what they would do is they would just refinance those loans into new debt. The problem is interest rates are so much higher now. If they refinance those loans into new debt, the payments on the new debt are even higher than the old debt. Well, they can't afford that because these buildings are vacant. There's nobody paying rent on them. There's no income to pay the loan. So take all these stories in aggregate, and you're starting to see a pretty ugly picture of what the most powerful people in the world are currently trying to do. You've got $1.5 trillion of this hot garbage commercial real estate debt that is maturing in the next 3 years. They've got to find somebody to buy it. The bond market will not buy it. Commercial mortgage-backed security issuance is down 85% versus a year ago. They can't just put this stuff up for sale in the open market. There's not enough buyers. The values will plummet, and this stuff is sitting on the balance sheets of banks all over the country. So if this stuff just goes up for sale on the open market and the values come down, you're going to have bank failures like we saw with Silicon Valley Bank, except it's going to be happening to all of the banks all over the place, namely America's small regional banks, which specialize in this kind of loans. So they've got to find a buyer. The market will have none of it. What do? You turn around and you offer this stuff to teachers' pension plans. And if I'm right about this, if they're using teachers' pension plans from across the country as exit liquidity, so some of the richest people in the world can unload artificially inflated assets onto unsuspecting poor people's retirement plans, in other words, get rich selling this stuff at the expense of poor people, well, that would be one of the biggest scandals to hit this country in decades. And it's happening in plain sight right now, and nobody is covering it. Nobody is talking about this. And look, to any of you teachers who are still watching at this point, congratulations, by the way. I know a lot of this stuff bores you guys, but this still affects you, and it's important that you pay attention. You need to know that this is happening. Your lack of interest in this subject will not protect you from the consequences of what's being done to your retirement right now. So you need to take this up with your union reps. You need to make them look, hey, what is going on in our pension fund right now? What are they doing? You need to take this up with your state legislators. What are they allowing to happen all over the country? Red state, blue state, folks, they're all in on this. They're all doing this together. And regulators and law enforcement need to look into this also. We've got all this new money is going to the IRS to hire tens of thousands of new IRS agents. Maybe they could start looking into the personal finances of some of the pension executives who are making this decision. After all, it's not their money that they're investing in this new $30 billion Blackstone fund. No, it's their pensioners' money. So why would they make the decision? Are any of these guys suddenly driving a very nice new car? Do any of these guys have a kid with a C+ average that miraculously just got accepted into an Ivy League school? We need to start looking at these questions. Who is benefiting from this? Because hundreds of thousands, maybe millions of people could potentially be losing because of this. So who is responsible for making these decisions? What are the names of the people that are signing off on this decision? And what is going on in the personal finances of the people who signed off on it? Those are the questions that need to be asked. That is what regulators, union officials, teachers alike need to be looking at. We used to have a free and independent press in this country who used to look into this kind of stuff. Unfortunately now, the only people you have looking into this kind of stuff are YouTubers like me who have nothing better to do but to dig into articles like this and shake their fist while they yell into the internets. But again, folks, I just want to mention there is no clear, obvious proof of wrongdoing here. There is no smoking gun. Maybe I'm wrong. Maybe the whole market is wrong and commercial real estate is really a great investment opportunity and maybe these pension funds are going to do really great. Or maybe this stuff really is the toxic waste that they're saying it is. Maybe nobody in their right mind would ever spend their own money to buy this crap, not at these prices. And maybe somebody is using your retirement to make themselves rich. And they're going to be long gone by the time the market crashes. And it's much more politically expedient for the taxpayers to bail out a teacher's pension fund than it is to bail out a BlackRock or Blackstone, isn't it? You can't help but wonder just how many politicians are turning a blind eye while this is happening right under their noses. Till next time, live small and dream big.